I am recording to the cloud starting now.
Okay, perfect.
All right, so welcome. We have Colleen from the New Haven Free Public Library. We also have Nicole joining us. I am Samantha Williams, the entrepreneur in residence for the New Haven Free Public Library. And as part of what I do, we have guest speakers come in and present for entrepreneurs and small business owners. So this week we have Matt Luciani with, is it Blueprint?
Yeah.
Blueprint Financial. So I will give it over to you, Matt. You can share your screen and start presenting.
Excellent. Thank you. Hi, everyone. This is Matt Luciani from Blueprint Benefit Advisors. I am an employee benefits consultant based out of Hamden, Connecticut, and I work with small companies to help structure their employee health insurance programs. So today, I thought that I would quickly take you through basically the what you need to know about implementing an employer health insurance program at your small business. So I'll start with a little bit of background on myself to lay the groundwork of where I come from, what my approach is to the business, and then I will get into basically how employer-sponsored health insurance came to be the norm for most people in the country. I'll then move to what the market landscape looks like in Connecticut and why it's really a no-brainer to implement through your business regardless of your business size. And then next I'll transition to discussing the ins and outs of structuring a medical plan for your company. And I'll share some industry secrets on how to stretch your dollar and really maximize the value of that health insurance program. And then to cap it all off, I'll just discuss some of the factors of the current climate in the health insurance world in the United States and how it affects small businesses, down in local economies. So with no further ado, let me quickly move forward to myself, but I'd like to shout out to Samantha Williams at Sam's Word and Colleen from the library. Thanks for hosting me here and giving me a platform to discuss this topic with everyone. Really looking forward to it.
Thank you.
Yes, we are too.
So I am a New Haven native, born and raised in New Haven, went to high school in New Haven. I studied economics and finance at Tufts University in Boston. And upon graduation, I worked for a little while in Manhattan doing mergers and acquisitions, investment banking. So my background is really in investments, and that's the way I look at employer-sponsored health insurance. It's a lot of money, and you should treat it as an investment. You're trying to maximize your return on that in every way possible. And so getting back to my transition from finance to health insurance, my family actually has been running a health insurance consulting agency for about 50 years now. So I represent the third generation of my family business.
Wow.
It was originally founded as Group Insurance Associates on Church Street in downtown New Haven in the early 70s. That was by my grandfather. My dad has been in the business for 35 years, and I am now carrying the torch here. So we are essentially consultants for group insurance products, also known as employee benefits. And that broadly includes medical insurance, group dental insurance, vision, life, disability. But for today's purposes, I just want to talk about the health insurance piece, because that's obviously, for anyone who's kind of explored it as an option, it can get very expensive, and it's certainly the biggest ticket line item for a lot of businesses next to payroll. So just a little bit about my business. We are an independent partner-owned agency. We don't have any national ties to like national franchisees. We are the largest independent consultant in Connecticut since 2013. We've grown from our humble beginnings in New Haven of 3 people. We now have about 30 people under our roof. And we're widely recognized by the health insurance carriers in Connecticut. We sit on the advisory council for every medical carrier, which I'll get into in a little bit. So we're really deeply rooted in the business, and we know really what's going on in the landscape at all times. So this is really our market. We specialize in advising small companies with between 1 and 50 employees. And hello to the new folks who joined. So again, this is tailored to the small business, even sole proprietorships. So lastly, I'll just note that we work on structuring customized employee benefit plans. This isn't a commodity business. It's not, oh, here's this health insurance plan product, the same as anything else you can buy. It's not like that. It's more similar to structuring like an investment portfolio really than anything else. There's so much customization and nuance to it. It really requires a close vetting to do it properly. So really our goal at the end of the day is to minimize the cost of health insurance for small companies and enhance the quality of those benefits so that the employees are well taken care of. So from here, I'd just like to quickly give a little bit of background, and while this slide may seem overwhelming, I promise you it's going to be the most densely packed slide in this presentation. So you can really focus on the red bullet points there because that's the essence of it. I really just want to discuss how employer-sponsored health insurance became a widely prevalent practice in the United States and where it stands today as the premier source of health insurance for most working Americans. So I'm going to start with the 1930s, Great Depression era. So at this time, most Americans actually covered their own health care costs, if you can imagine that. I mean, think about trying to go today without health insurance, but that was how it was back in the 1930s. Costs were not egregious. Many people could simply take care of themselves when they needed to. You need to see a doctor or get a procedure done. The cost basis was such that most Americans could simply afford that in their personal budgets. Most employers did not have like a sponsored healthcare plan. Really, the only companies that had anything that closely resembled that model were industries that were sort of manufacturing or construction based, where you have people in physical labor. Those types of companies, those industries would actually have company doctors and union operated facilities. So other than that, everyone else was sort of on their own, and you'd see, your family practitioner or whoever, but there was no, really no such thing as employer-sponsored health insurance. With the onset of the Great Depression, obviously everyone's budgets were quickly shrinking and it became very difficult to afford healthcare. So this is sort of where the need for a subsidized or a supplemented healthcare solution came into play. And it was really sort of brought on a little bit faster by World War II. Many Americans, mostly men, were sort of going abroad to fight in the war, so there was a labor shortage. And in addition to that, there was high inflation because the economy was trying to churn out resources to fund the war, food and supplies and things. So in response to high inflation, employers were hiking wages, right? Things were more expensive and they needed to pay their employees appropriately in order to keep them. So as a result of this, the government said, look, we don't want employers raising their wages too much because it's only going to sort of double the inflationary process. So in 1942, the government basically limited the employer's ability to raise wages through the Stabilization Act. And so as a workaround, employers said, all right, I still need to compete for labor. I need to incentivize people to come work for me. So instead, I will offer you health insurance. I will pay for your medical insurance costs rather than raise my wages. Health insurance was non-taxable, so it became very, very popular as an alternative compensation method. So from there, it really took off and became what it is today. It turned into a widespread, prevalent practice, especially in unions. You think about how big health benefits are for unions today. If you go back to the 1950s and the 1960s, that's when unions, really aggressively bargained for very rich benefits, vision insurance, dental insurance. So by the 1960s, doctors in the United States sort of naturally had to increase the price of service due to widespread benefits. Everyone had health insurance that was effectively fully funded. If you wanted any procedure whatsoever, you go down to your local doctor and it's covered. So there's a high volume of medical services coming in. Doctors just sort of naturally had to, increase prices to reach that, to match that demand. So this resulted in retirees. If you think, these are people not working, so not having access to those employer plans. Retirees were still at that time on their own for paying for their own medical expenses. They couldn't afford these rising costs in healthcare. They didn't have a subsidized employer program. So in 1965, Medicare and Medicaid come on to the scene to help with that. But that just sort of goes to show how prevalent benefits became, and it sort of cut out the retiree market and other people who didn't have employer-based programs. So fast forward to today, through the 70s, the 90s, and the 2000s, obviously inflation in the economy and rising healthcare costs. We get to 2010, and the Affordable Care Act is passed. It has some employer obligations attached to it, some carrier obligations, but overall, that is sort of the status quo of the market for the most part. And if you look at today, statistically, 85% of businesses in the United States offer some form of a health insurance plan, and 80% of Americans under age of 65, so really the workforce, 80% of the workforce, are insured by an employer-sponsored plan. So that's the message: it is now the norm. It has been the norm for a long time, and if you're a small business and you're attempting to attract and retain good talent, you really need to have it. It's something that's everywhere, and it's really an expectation. So, I'd like to just kind of take you into what the market in Connecticut looks like for employer-sponsored health insurance and what you need to know if you're considering setting it up. So the first thing I want to mention is that there's a misconception that in order to have an employer-sponsored health insurance program at your company, you need to have like 10 employees, 15 employees, 20 employees to qualify as a group, quote unquote. So you can actually qualify for a group plan with group pricing with as few as 2 employees total. So that includes you as a business owner and one other person. It doesn't really matter whether they're part-time, full-time. If there are 2 of you who operate in the business, you're considered a group. And it doesn't mean that, both of you need to enroll in a plan or something. It just means that you qualify to offer a plan through your company, even if you, the business owner, are the only person who's going to enroll in it. So that's really the key. Is it's not limited to companies of 10, 15, 20 employees or more. If it's you and one other person, you're in. And really, there are a couple carriers who even write sole proprietorships. So there are a lot of ways that you can funnel health insurance through your company, and there are some serious benefits to doing so, which I'll get into later. But currently, I just want to talk about 3 of the main markets if you're a small company in Connecticut. So the first is if you have between 2 and 50 employees, you can access 4 medical carriers off the bat, no questions asked, no limitations. There are about 135 different medical plan options in that market. So just to put into perspective with your alternative solution, which is individual insurance, a lot of people have individual insurance through certain circumstances. You have access to 2 carriers on the individual exchange in Connecticut, and only 15 or 16 plans total. So once you get into the group market, it's now 4 carriers, 135 plans total. It's a very different game. So think more variety, more access to catering to your specific medical needs. So it's a whole different ballgame.
Hey, Matt.
Yeah.
Do you want us to hold questions or ask during the presentation?
Feel free to ask as you go.
Okay, so Nicole had a question. How would the health insurance work for sole proprietorship? She has a hair business, custom designs by Nicole.
Yeah, good question. There are there are certain carriers in that first market that I mentioned, not all of them, but there are a couple who still write sole proprietorships as groups. So really, if the question is, do you qualify as a group? The answer is yes. And we can get into details later on in the presentation on like how you go about setting that up and where your starting point is. But
Okay.
if that's kind of the essence of the question, yes, you would qualify as a group, and you can access this market.
Okay, thanks.
Okay. In that small group, and this would apply to that sole proprietorship question, it's mostly an age-based rating system, and that's been the case for a while. Most plans that fall under the Affordable Care Act are age-based rating systems. So, it's age separated. Older folks have higher rates than younger folks and so on. There are some exceptions to that rule, but that's sort of the nature of the rating. If you surpass 50 employees, I know most people in this presentation won't be in that market, but once you do, you have access to 5 medical carriers. You can really customize your plan a little bit more, unlimited plan designs, and you're no longer age-based rated, it's composite rating. So they sort of take an average demographic, age, gender mix of the group and say, all right, here's your rate for each person. A single rate applies to everyone. But really what I want to get into is the last bullet point. There's a sort of third and middle market here. And this has been, extremely popular in Connecticut for the last 3 years since it really opened up to small companies. But it's a special market for healthy groups, and I put healthy in quotes, because really it's simply groups that are a little bit healthier than the average person in Connecticut, which is not that healthy. You think about, tobacco use and so on. If you're sort of a middle of the road, individual in the health spectrum, you're probably going to qualify and get into this market. But basically, you get everything mentioned above plus 5 additional health insurance carriers, 30% lower cost on average, and rates are based on your health history rather than simply your age in a nutshell. So this is very, very high level, generalized. I don't want to go into too many details yet, but this is kind of a snapshot of what the market looks like. You figure out what market you fit into, and that's kind of the basics. And here are a few of the health insurance carriers that play in Connecticut. I would imagine many of you are familiar with some of the names here, like Anthem, Blue Cross, Blue Shield. Samantha, any questions at this time, or should I keep going?
No questions right now.
Okay.
Hey, Matt, I actually do have one question.
Yeah.
Are you going to go into what constitutes a healthy group?
I can. It's a little bit ambiguous because I don't determine that. The health insurance carriers determine that, and it's entirely based on the group's health history. So unlike the regular marketplace, like in the first 2 bullet points, this sort of healthy group market, the carriers require you to disclose your health history for the past 5 years or so. And they sort of evaluate if you have any chronic conditions that would be high cost to them. They evaluate what type of prescription medications you're taking, any major procedures you've had in the last 5 years, and they sort of assess, what your risk profile is based on that. So it's not simply like, hey, if you haven't had a heart attack, you're in. That's not really how it works. It's very, very nuanced. They ask a great deal of questions, and the underwriting guidelines vary based on what industry your business is in, what they expect your demographic to look like, and also which carrier you're talking to. So there's not much I can really get into here. I don't even necessarily have the answers. All I can tell you is that in many of the groups that I consult for, I can't tell you how many I've seen where someone may have had a cardiovascular surgery in the last 3 months. Another employee is on a second heart attack, and there's someone taking extremely high brand name medication. And so a group of maybe only 6 or 7 people, and you'd think that blows them out of the water, but based on how the carrier looks at it, they recognize that it might be a cost they can manage or contain, and they accept them. So, some groups you expect to get in and you don't. Others is the opposite. So it's a little ambiguous. So hard to answer that one.
Oh no, that was a great answer.
So
Okay.
I have two questions.
Yeah.
One, what about the Access CT, the open marketplace? How
Yeah.
does that work?
Yeah, Access CT is what's referred to as the individual exchange. That's where if you're an individual and you can't, get coverage elsewhere or don't want to, you would go and look for an individual health insurance plan for yourself or your family. So there you have only access to two carriers, Anthem Blue Cross and Connecticut. But in total, there are only like 15 plan designs you can choose from. Like it's very limited. In the group market, you're talking about almost 150 plans. You're talking about 10 times more, variety and ability to customize and find something that caters to your needs. And the individual market, it's very limited. And we'll see.
And what about costs?
Yeah, I was going to get to that. We'll see in the next slide how that relates to costs. But in a nutshell, you're going to get about 15 to 20% cost savings in the group market versus individual. Now, there are some exceptions to that rule because, as you may know, when you go to the individual market, if you're below a certain household income level, you get a government subsidy to help pay for it, and your costs can go way down. So if you're in that category, then the group option may not be the best, but for a lot of people who are over like $40,000 in household income, this is going to be far better than what you find in the individual market.
Okay, and then my other question is, do you think, or is there potential for small business owners to hire or not hire candidates based on how they think it may impact their health insurance plans that they offer? So if they know, like, are they like women, are more expensive to cover because we can have children, right? So you have that risk of pregnancy that you'll have to cover in childbirth. Or if they know that you have some kind of disability, do you think employers factor that in when making a decision?
So yes and no. So I think to take a step back, to understand from the employer's perspective, like what the cost components are, as an employer, you do not necessarily need to pay for your employees' health insurance.
Oh, okay.
So that's a key, and I'm going to get into in the next slide. But many employers simply install a group health insurance plan, offer it to their employees on a voluntary basis if the employee themselves would like to get in and pay for it themselves, and simply say, look, it's here if you want it, and I as a business owner am going to pay for mine, and if you also want to get in, you can do that, and you can pay for your own that way. Okay. And so from that standpoint, as the employer, you're not so concerned about who's coming in if the situation is that you just really have it for yourself and as an option for access to your people if it fits their needs. Now, if you're in the other situation where you are actually funding health insurance for your employees, it depends on which market you're in. So if you're in like the market in the second bullet point there, the group with 2 to 50 employees, the rates are set in stone from the very beginning, and they're based on age and age alone. So it doesn't matter if you're hiring someone who may have severe medical conditions or hiring a woman who might be pregnant and ready to give birth. The carrier, whether it's Anthem or Aetna or whoever, they don't really care. They're blind to it. They basically say, look, all I know is you're 47 years old, so here's your rate, period. I don't care what you've had going on before or what you may have going on. This is what your rate is.
Hey, Matt.
Yeah, go ahead.
I have a chronic illness, and I do know the answer to this question. With the American Disabilities Act, if you are covered under that, they legally cannot do anything about that with hiring.
Well, yeah, I'm not. So I think that's a separate question. Is
oh, okay.
Talking about hiring, like employer discrimination, sort of. This is sort of a different realm. This is employer health insurance. So I guess the connection there to your point is, yeah, if you're funding your medical plan and you're in a plan that penalizes you for super high costs, then yeah, in theory, if you're hiring someone that you know has a lot of issues, technically you're not supposed to discriminate against them, but for the most part, for small businesses, the fact that someone may have high cost claims or high cost medical conditions doesn't affect you in the least. It affects the carrier.
Awesome.
So, you hire the person, if they're driving up $1 million in claims, that's the carrier's liability, not your liability. It's not like you're paying for that. You're simply arranging a plan that has a set monthly cost at every age group, really. And if you bring in, a 50-year-old to join your company, you already know what that cost is going to be right off the bat. It's a set monthly premium, and whether they have $0 in claims in the year or $1 million, it's not affecting your monthly cost. It's on the carrier. It's the carrier's risk to insure. So does that answer those questions a little bit? I know we're getting into
Yes.
it. Okay.
Sorry to take you on that tangent.
No, that's fine. So I think this next slide is going to be kind of helpful. So why group health insurance is a must-have for small companies? Obviously, first and foremost, I've already mentioned this. It's the key component for attracting and retaining workforce talent in a lot of cases. It has become a norm. It's an expectation for employees. Do you have health insurance? 85% of companies in America offer it. 80% of people in America who are in the working class are covered with an employer-sponsored plan. So it's a must-have. So the question is, okay, if I need it, what's my liability? What's my exposure? And the key is you don't need to contribute to your employee health insurance premiums if you're a business owner. So if I'm a business owner, I have 3 employees. If ordinarily I'm getting my health insurance through the individual market, I realize that, hey, if I did it through my business, I can just cover my own costs. I can get it myself. I'll save 20%. And then I'll offer it to my folks. I'm not going to pay for it, but I'll offer it to my folks and say, look, if you want a more affordable health insurance option, here, you can have it. You can pay for it on your own basis. And there are a number of ways you can do it. You can deduct out of payroll or however you need to do it. But you say, look, it's there for you. I'm not going to pay for it, but you do have access to it. And if you want it, feel free to come aboard. It becomes your health insurance. You're paying for it. So you don't necessarily need to fund this. It's not a huge line item. If you currently have insurance through the individual market, you could probably do much better through the group market and only cover yourself. You're not responsible for covering other costs. So that's a key reason why it's really a must-have for small businesses. The other point is with a small business, you can offer multiple medical plans to your employee population. So it's not like, okay, here's the plan and you either want it or you don't. You can say, here are your 4 plan options. Here are your 4 medical plan options. You can't do that in the individual market. Mm-hmm. So if you have a small business and everyone has diverse medical needs, you have someone who never sees a doctor, you have someone who takes 3 prescription drugs a month and they see the doctor regularly for various diagnostic reasons. You have 2 different medical plans for those people and you give them a variety for them to choose from. So it really, it's a great way to say to a prospective employee, look, come aboard with me, whatever your health circumstance is, I have 4 or 5 different plan options that'll fit what you need and it will save you a lot of money versus what you could get on the individual market. And again, that's nothing that you paid for. That's just saying, here's access to it. So that's a key component. And then obviously, Samantha, we've already touched on this at the bottom. You typically save 15 to 20% versus the individual market. Most importantly, the premiums you pay are pre-tax with group health. So whereas right now, if you have an individual plan, you're paying monthly premiums to Access Health, those are regular dollars, post-tax dollars. These are pre-tax dollars. They're either a write-off for your business or you route them pre-tax through payroll. So you save probably 10 to 15% in tax costs alone doing that. So a lot of reasons to run it through the business. A lot of benefits here. A lot of people probably aren't quite aware of. Any questions here?
I don't think so.
Okay. So I'm going to move on to how do you implement a medical plan at your company if you're interested in doing this. You say, okay, this might make sense. Well, first and foremost, you need to work with a licensed agent or consultant to be able to access these markets and arrange this in the first place. But the key considerations to make are, what's the size of your group? If it's a sole proprietorship or 2 or 3 people, that's one thing. If you're 30 people, that's another thing. What's your expected enrollment? How many people do you expect to participate? Is it just you? Is it going to be 15 on your staff? That's a major consideration. What's the overall health profile of your group? Do you know of major issues going on? Or do you think that your group is relatively healthy? Because if you are, you can probably save 30% through a different market. So there are those considerations, and your consultant kind of handles that for you. And then it becomes, all right, let's sketch out a preliminary medical plan design. What do you have today? If you have an individual plan, let's look at what those benefits are, and we can try to match that if that sort of fits what you need. Or if not, if you really want to start from scratch and get creative, let's talk about what your annual medical needs are. How often do you see the doctor? Are you getting all your preventive wellness visits done, your physical, women's OBGYN? Do you have medications you take on a monthly basis? Let's structure a plan that fits those needs and gives you the best overall cost efficiency. Let's evaluate what plans are being offered in similar companies in your industry. If you have a main competitor that you're competing with to attract, workforce talent, let's figure out what plan they have. I mean, we can't do that specifically. That would, we'd sort of infringe on their privacy, but you have access to general benchmark data in the industry. You say, okay, I'm in the manufacturing business. The average manufacturing company in Connecticut with fewer than 50 employees offers this type of medical plan. That data is available. So if you want to figure out how to compete with, companies in your industry, that's what you do. Next, you would gather proposals from the marketplace. Every carrier who you have access to, your consultant would go out to and try to arrange this type of contract. You gather that information, you conduct comparative analysis and figure out where your best value is. It involves looking at the strength of the contract, the benefits involved. It looks at, evaluating the strength of your medical network. There's a big difference if you have a Connecticut network versus a Harvard Pilgrim network. One's localized, one's regionalized in the Northeast versus Cigna network. It's national. So it's like, what are your network needs, and do your doctors participate? Obviously from there, you look at your sort of finalists, and you leverage those competitive contracts against the carriers. And you say, look, Anthem, I've got a great contract from Connecticut. Do you want to try to match this? Do you want to come down a little bit and we can maybe do something? So there is certainly a negotiation involved. After doing that, you sort of identify your optimal contract, you make any final tweaks you need, and you have the plan you're looking for. And it's just about installing it at that point. So for installation, you kind of figure out, okay, am I going to contribute at all to the cost for my employees? In other words, if I'm offering, do I want to sweeten the pot and contribute to some of this cost and make it really affordable for them? Or am I just sort of offering on a voluntary basis? And either is fine. But if you're going to do that, have an open enrollment meeting with your employees, educate them on the plans available to them. If you're offering 3 or 4 plans, go through each one so they understand what's the best fit for them. Help them understand how to best utilize it. And then finally, finish the implementation. You distribute your employee medical ID cards and you're ready to go, usually effective the first of the month on any given month of the year. It's not like the individual market where it's only January 1st. You have companies that start on May 1st, companies start on August 1st, September 1st. It can be any time throughout the year that you start this. So it's not like an end of the year thing. You could do it next month if you needed to. And of course, if you are, if your employees are paying into it and they're going to take it on their own costs, you can do a payroll deduction. If you're paying them, $500 a week, you can withhold, $100 of that or $50 of that, whatever the cost is on a weekly basis, so that it's pre-tax to them and it's all getting funneled through the business. I know this is kind of long. This is probably the second most dense slide in the presentation. So any questions on this? I promise it's going to be a little bit smoother sailing going forward.
I have a question.
Yeah.
Where are you getting all of this stuff that you have to fill out for this stuff?
From your consultant.
Okay.
Yeah.
I have a question.
Yeah.
So we have you, but ideally, how would you find a consultant?
You can go to the Connecticut State Insurance Department. Sometimes they'll have a registry of licensed agents in the state. However, I sort of discourage that because there are so many people who can be licensed to sell group health insurance that are often doing it on an independent basis, like out of their basements or garages. Not that that in itself is a bad thing. We all start small at some point. But to really know what you're doing, I mean, you have to be deeply rooted with the carriers in this industry. I mean, I can, someone who's been in the industry a long time could pick up the phone and call, the head of underwriting at Anthem Blue Cross and vouch for your company to get a good rate versus the person who kind of does this on the side, who is like, okay, I can maybe find you a plan or a rate. It's very different. It's two different worlds. So I guess, honestly, if I were to start from scratch, I would Google health insurance, agencies or brokerages in Connecticut, and see.
And you'd be looking for the ones that are more established like yours, that have been around for a longer time, that kind of thing.
Yeah, and you can't always, it's not always immediately clear, but I would say ask around, talk to local business owners who may have an employer-sponsored health insurance program. Say, hey, who do you work with for this? And they'll probably point you in a pretty good direction. You pick up the phone and just and ask these questions and see who seems knowledgeable or who you'd like to work with. At the end of the day, it's certainly not a commodity. It's not like, okay, this person's going to do the same as that person. It's very different. It's more like financial planning. Like it's structuring a diverse portfolio that has a lot of moving pieces. So it's certainly not commoditized, but at the end of the day, you want to work with someone you're comfortable with. So that's pretty important too. But certainly talk to local business owners. That's probably the best starting point.
Thank you.
Yep. Okay. I'm just going to quickly touch on what a typical medical plan looks like in the group market. Here's just a quick illustration. This happens to be a plan that was arranged with Anthem Blue Cross Blue Shield of Connecticut. Some of the main components here that you should be thinking about if you're considering, a health plan. And again, most of these factors are pretty customizable, but obviously, what's your medical network? What carrier are you using? That makes a big difference. Anthem Blue Cross Blue Shield has a national network called Pathway PPO that's seen in this plan. They also have a localized network. They have the Pathway HMO. It's limited to the state of Connecticut. It's like, do you have an employee in New York or working in Massachusetts who might need something outside of Connecticut? That's a major consideration. What are your cost exposure limits? The way health insurance plans work is it typically gives you an outline of what your portion of the cost would be for any given medical procedure and what is going to be picked up by the carrier. So, what is your ideal deductible size? Do you want employees to have a very small deductible exposure, like a $500 deductible on the year? I mean, that's very, very little for, what, most medical procedures cost. But, on the other hand, you have someone who's super healthy, almost never uses the plan, simply wants a catastrophic backstop, and you give them a $5,000 deductible. I mean, there's no right answer. It's, you have to kind of suit your needs, but that's a major component you're playing with. It's like, what's your immediate layer of cost exposure for this plan? A lot of people don't know what an out-of-pocket maximum is. That's basically your overall limit for expense on the year, no matter what your scenario is. It includes your initial deductible. It includes any small copays you may make on the year. So in this particular plan, I'm showing a plan that was structured with a $1,500 deductible. That's sort of, middle of the road. That's a nice plan. To say, look, your deductible is only $1,500 for the year, and that's pretty good. It's a gold level plan. And so if you were to hit that, if you have a major surgery, $1 million surgery, and you hit that $1,500, then for the rest of the year, you're mostly paying just kind of small copays as you go, a $25 copay for the doctor here, a $10 copay for the lab here. So the overall accumulation of those costs is what goes into your out-of-pocket limit.
Does this work like car insurance where you pay up front for it, or you pay, is there any upfront cost to it, or you just have your deductibles?
Your upfront cost is your monthly premiums, your monthly cost for the plan. So, you know, if your monthly premium might be, you know, $200, $300, and you're paying that on a monthly basis. And so you're putting in $200-$300 to the carrier every month, and then whatever your usage is, your cost for that usage is based on how your plan is structured. So you could structure a plan with 0 deductible. You could structure a plan that basically covers everything for you right off the bat. It's going to be very expensive on a monthly basis, but it's entirely customizable. So I guess it would be both and to answer your question.
And then
so there's no sign up. Oh, sorry. There's no sign up cost. Is that what you're saying?
Well, to own the plan, to implement the plan, there's a monthly fee for doing that. It's called your monthly premium. It costs you something to have the plan in the first place. There's not like an upfront cost to implement it, if that's what you're asking. It's not like, okay,
Yes.
I pay. No, nothing like that. It's just simply whatever your monthly premiums are. There's no like lump sum up front.
Okay.
And then can you pay annually for that if you don't want to pay monthly?
That's a good question. Most you can, but most people wouldn't. For one thing, you don't get like a cost benefit for paying annually. It's not like, all right, if I pay annually, I get, you know, a bulk discount, a temporary. You don't get that. The reason it's monthly is because the contract is really on a month-to-month basis. So if something happens, like, you know, some people in the COVID crisis right now who are hurting in their businesses, they might not be able to fund their health insurance, you know, month to month anymore. So they will terminate their plan. You can terminate your plan at any time. So it's like, you know, you're not going to pay a lump sum up front and be locked into it for a year. You pay month to month, and, you know, assuming you continue to need it, which most people do, you're paying that premium. Otherwise, you can shut it off at any point.
Okay.
I just want to touch quickly on 2 main types of plan classification. There are really 2 buckets. There's the traditional / copay style medical plan, which is actually exactly what you see here in this illustration. This is a plan that has predetermined flat fees for any type of service you're getting, whether it's a primary care doctor visit or a specialist doctor visit, or you're getting a lab service or radiology. There's a set fee predetermined. So you know, okay, if I go for an x-ray, it's $40 flat, period. I know I'm not paying the full $500 charge. I'm paying just $40. That's a copay style plan. Most people in the state, I'd say about 65% of people in the state of Connecticut are insured by a copay style plan. It's the classic type of plan because you want to know what you're paying right when you go in. The second bucket, which is a little bit newer, not quite as prevalent, but it's a very good fit for a lot of people, is a high deductible style plan. And it's not exclusively just a plan that has a higher deductible. It's actually a plan that has a higher deductible, and it strips out any of the flat fee copays that you may have structured here. So in other words, instead of you knowing, okay, $25 for a primary doctor, $50 for a specialist, instead it's, okay, there are no flat fee copays anymore. It's not predetermined. Instead, it's whatever I'm getting, I am going to pay the full price for that service, whatever the doctor charges. It's counting toward my plan deductible, but it really depends on where I'm going for it. So if I go for an x-ray at a hospital, I'm probably paying $500. If I go for the x-ray at the freestanding facility, probably paying $120. So it's more of a consumer-driven health plan where you sort of, you know, really have to think about where you're going and manage your own costs. It obviously has inherently more exposure to it because you're not getting, you know, low flat fees, but in return, the cost of the plan on a monthly basis is a fraction of what you get with a copay style plan. So instead of paying a monthly premium of $300 to have this plan, you're probably paying like $120 to have a high deductible.
So would you suggest this for someone with a chronic illness?
It depends what the nature of your illness is. If if you can reasonably expect what your annual medical services are going to be, and you can look at a copay style plan and say, okay, let's see, I'm seeing the doctor once a month, I'm seeing a specialist once a month. So if I have the copay style plan, it's $50 every month. Let me do that math. Versus if I go with a different style plan, it's probably going to be around $100 every time I see a doctor. I'm paying the full price for the visit. But what am I saving, in overall monthly cost of the plan? It really depends. And this is where, the consultant comes into play. This is where structuring the medical plan, you go through sort of a discovery phase and a long discussion to figure out what your best solution is going to be. So can't give you a perfect answer there. Yeah.
Yeah.
Okay, I'm going to move on to talk about what else you can do to add to this. This, what you're seeing here on the screen, this is a standalone medical plan. This is like, here's your plan design. It's a product. You're paying for it on a monthly basis. It is what it is. But there's so many things you can do to supplement this and basically enhance the richness without necessarily paying for that richness. And that sounds kind of confusing, but let me get into it. So there are a few really creative strategies, and these are really like secrets of the industry that well-informed small employers are adding into their medical plan. And the idea is that if you can have a medical plan that is extremely rich, but it's not priced that way, it's priced much more cheaply, you would want that. It's something you inherently want. You want much more value for a lower cost. And so what all these items do, and I'll walk through at a very high level, is they basically take a kind of low level or very basic medical plan that's not super rich, not super nice, and you infuse it with these creative little tricks and turn it into a very rich, high quality medical plan without necessarily paying for it. So here are a couple ideas. The first, and this is so common with small businesses that really know what they're doing, is a health reimbursement arrangement. This is my top bullet point because I think this is just a genius model. Basically, the idea is if you're considering offering an employee health insurance plan to some of your folks at your company, and you're deciding like what size deductible am I going to give my people? I obviously want to give them a small deductible as possible, but there's a cost of doing that. Rather than giving someone a $500 annual deductible right off the bat, super rich, costs a lot of money, what you do is you say, look, I'm actually going to give you a $3,000 plan deductible. I know it seems like a lot, but what I'm going to do behind the scenes is me as the employer, I will fund some of your deductible costs if you incur it. So instead of giving you a $500 deductible plan, I'm giving you a $3,000, but I'm going to make you a $2,500 promise that after your first $500 you spend, if you continue to incur medical expenses, I will fund that $2,500 for you. And so it's a $2,500 promise by the employer, which obviously, that in itself is not small, but compared to what the plan alone would cost if you were to do a super rich plan, you're saving a ton of money and you're not guaranteed to pay that out. So what you're saying is, look, I'm basically giving you a limited exposure of just $500. But let's say you only have $400 of medical expenses in a year. Let's say you have a healthy year. Your employee only spends $400. You didn't have to pay out anything. They're still in their $500 layer. But they have that promise and that sort of support, that cushion if you need it. So you made a $2,500 promise, but you didn't have to pay it out. That's what a lot of small employers do. They say, look, I think that my employee base is pretty healthy. They're not going to really use the plan that much. But let me make them a promise of a super nice medical plan should they use it. And over time, you're not really going to be paying it out. You might have an instance here or there, but in the long run, you're going to be saving a lot of money rather than like buying a super rich plan right off the bat.
I have a question. So if you have employees and you're offering some of this stuff, I know you're going to go into more of it. Like this isn't something you would just like hand them a packet about. You would want to make very clear, like what the differences are and like talk with them about it?
Yeah, you're having like an hour-long meeting with them on site with your staff, ideally with your consultant there. You're walking them through the ins and outs of the plan, explaining the nuances, and also educating them on how to best use it. Like, you know, if you feel like you have a cold, don't go to the emergency room. You're going to pay $300 for the emergency room. Go to an urgent care center. You know, you'll pay $50 for that.
Mm-hmm.
So it's not only explain the plan, it's how do you use it best. So yeah, absolutely, Colleen. Certainly.
Okay.
The second item here, a lot of people are probably more familiar with this, HSA. It's a kind of a hot acronym in the health insurance business. It stands for Health Savings Account. This came into play in the early 2000s. Basically, the government said, look, if you have a certain style medical plan with a high deductible, obviously there's a lot of cost exposure on you. And so to help you with that, we will allow you to open a new bank account. You could do it with whatever banking institution. You know, if you check with Bank of America, you can open an HSA with them. Totally free to do it. And that account is qualified for you to make pre-tax contributions into, so that account will hold these pre-tax funds, and you can pay your medical expenses. Like when you go to the doctor, you go to the hospital, you can pay for those bills with pre-tax dollars rather than regular dollars. Mm. So if I know I have a hospital procedure coming up and it's going to be $1,000, if I've got a week or more before that procedure, I'm going to open an HSA. I'm going to put in $1,000. It's a write-off, pre-tax. It's going to give me a bigger tax refund at the end of the year, and I'll use that to pay for the hospital expense rather than just regular dollars on my credit card or what have you. So where it comes into play with the employer is if you're offering a health plan to your employees and you want to sort of give them this ability to use pre-tax dollars, you can open the account for them, and you can even fund it for them. At least initially, you can say, look, come aboard with me. I'm going to open up a health savings account for you, and I'm going to put in the first $50. I'm going to start it for you. Here's your first 50, and now you're off and running. You can contribute to that on your own throughout the year, and use those dollars to pay for. So that's a nice little mechanism for employers to use. It's very, very popular today.
When employers do that, do they have is that a tax incentive for the employer to give them the $50?
Yep, it's a write-off for the employer. It's a write-off for the employer, and then it allows the employee to now have access to that account, either use the dollars to spend or continue to fund it on their own with more pre-tax dollars. The last two things I'll get into, I'll spend a little bit less time on, but self-insured medical plans, also known as self-funding. This is really more prevalent with larger companies who have more consistent and anticipated cash flow. The idea with a self-funded plan is, I'm actually going to go back to this plan I was looking at before. Rather than having a plan like this, where you're saying, all right, it's $25 every time for the primary doctor, $50 for your specialist. There's a cost component for the employee, and then the insurance company is paying the rest. Like behind the scenes, you don't realize, yeah, it's $25 for the primary doctor, but the doctor's also getting money from the insurance company. It's part of the contract. You're paying the $25 as the employee to the doctor, but the doctor's also getting like $60 or $70 from the insurance company for that service. So that's why premiums get very expensive. With a self-funded plan, the idea is that rather than paying a very high premium every month and ensuring that the carrier is going to be paying these claims for you, you as the employer take on the prerogative of paying the hospitals and the doctors yourself. And in doing so, you're saving a ton of money by not really paying for health insurance premiums. You pay a very small fee to the carrier to basically rent their network. You say, look, Anthem, Blue Cross, Blue Shield, I'd like to establish a self-funded plan. I'm just going to rent your network. It'd be $30 a month. Here's your 30. I'm renting your network. My employees now have access to your network of doctors. And when my employee goes to the doctor's billing, whatever it is, $95 for the visit. Me as the employer am now paying that full visit, or I'm paying that full hospital stay. And so there's a little bit of risk involved, because if someone goes in for you know, for cardio bypass surgery, that's a $20,000 bill you're picking up as the employer. But if you have a relatively healthy population where they're just kind of getting doctor visits here and there, I mean, it's possible you're instead of paying a $300 monthly premium for that plan, you might be paying $30 in a fixed fee, and then you're maybe paying, you know, 20, 30, 50 bucks a month just to pay those doctors off. So that's kind of an interesting thing. Probably not a good fit for small businesses because there's a lot of risk involved, and if you can't really anticipate a big cash flow cushion, it's tough. It can be a risk.
What about for sole proprietors? Would that be a good option?
Well, for sole proprietors, typically to structure a self-funded medical plan, you usually need at least 5 people to be on the plan. That's usually a requirement. But what I would say is if you're thinking about that as a sole proprietor, you might as well just not get a plan. If it's just yourself, you might as well just use your personal funds to just pay doctors on a cash basis.
Okay.
You know what I mean? You might say, all right, I'm going to forego a health insurance.
Just be
plan.
uninsured.
Right. I'll be uninsured, but I know that if I'm only seeing a doctor a couple times a year, all right, I'll pay the $100, you know, for that visit. I'll pay the $100 for that visit. And I don't have a monthly premium on my back. So,
but that's riskier in case something happens.
if something happens, you might be stuck with a 6-figure hospital bill.
Right.
You know, so.
Okay.
And then just with network structure quickly, you know, promote people being good consumers, positive consumers, understanding their network. The best move is to go to an HMO style network today, which simply means that it's usually a well-defined regional or local network. It might be just the state of Connecticut, and you can't go outside of there. But know who your doctors are in network. It's usually all the hospitals in Connecticut, and just say, look, this is your network. Go to your network doctors. It'll save us some money rather than having this open access national plan where I'm paying for doctors I don't even need.
But how does that work if you're traveling? So you have the closed plan, regional, but you're in Florida and you have an accident, something happens, you have to go see a doctor in an emergency room.
Excellent question. I always use the example of the parents taking the kid to Disney World for the first time in Florida. To your point, if my plan is HMO and my network is limited to Connecticut, what happens if I'm in Disney World and my kid breaks her arm? The answer is that insurance carriers will honor anything that's an emergency, even if it's outside of their network. As long as it's an emergency, they will cover it. So whether you're in the state or out of the state, or you're across the country, if you have an emergency and need service immediately, wherever you go, the carrier will cover that as if it's inside your network. So great question.
So they won't cover prescriptions. So like if you're getting your prescriptions and you went to visit your mom for 3 months because she was sick, like you're paying out of pocket for those prescriptions?
Most likely, although prescriptions is another story, because typically unlike a medical network where it's specific to like this doctor, this hospital group, this state, prescription network is usually based on the vendor. So it's CVS or Walmart or Rite Aid, and they're everywhere. So you can pretty much fill a script anywhere in the country, even if you have like a state-based network.
Cool.
Yeah. Okay. Let's talk about what's been going on in the health insurance landscape recently in the last 10 years, because this is kind of interesting, and it really has a significant effect in small businesses. So, you know, as everyone probably knows, in March 2010, the Affordable Care Act was passed. And, you know, the idea was to increase access to healthcare with fewer limitations on pre-existing conditions, and sort of incentivizing everyone to get insured and to be healthy, to use their preventive benefits. So there were a couple things that took place with that legislation that affected the employer, what their obligations are, the employee, how they're rated, and also the carriers and what they're responsible for. So I just want to talk about a few of the points and how it has sort of developed in its first 10 years. So the first thing that's important to note, and I sort of mentioned this earlier, that for most small companies, the way that your employees are rated is based on age and age alone, purely age. It has nothing to do with what disabilities I may have had in the past or what high cost conditions I have. If I'm looking to hire you and you're coming on my medical plan, the only thing the carrier cares about is how old are you. You're a 47-year-old, great. If you're a 48-year-old, you're going to cost a little more. 49-year-old costs a little more, so on. And that had been the case for a long time, but before the Affordable Care Act, carriers could sort of they had the right to sort of say, okay, I'll cover whatever you're having, but just I need you to answer these questions about what your situation is so I can rate you appropriately. Because if you have something that, is super high cost and that I'm going to be paying for, I need to rate you appropriately for that. And so the Affordable Care Act basically, they did away with that, say, look, everyone's simply rated based on age, no matter what your health situation is. And that was good and bad for a couple of reasons. But one thing it did is, obviously, when you do that, you have to give higher costs to the older people. You have to expect that older folks are going to have more medical conditions and higher costs. But they didn't want it to be too heavily weighted on older folks. They didn't want to say, look, 60-year-olds, 70-year-olds are paying the big dollars. So what they tried to do is say, all right, here's our age spectrum. We're going to try to take some of the cost weight out of the older folks and switch it to the younger folks to make it a little bit more even. But what that did, unfortunately, the unintended effect of that is that once that was instituted, younger folks who tend to make less money because they're new in the workforce, they're fresh out of school, they couldn't afford the premiums that they were being given. And so a lot of young people were priced out of the market. They didn't participate in health insurance for the first few years of this. And as a result, as you can imagine, if you have young people non-participating, they're staying out of this. The pool of remaining people are older in nature, naturally, and they have higher claims, as you would expect. And so basically the risk pool was unhealthier than intended because young people were not participating. They were coming out. It was all older folks driving up claims. And so claims began to accumulate very quickly. And carriers simply had to react in response to that and raise their rates. And it perpetuated this whole thing. Younger people keep coming out because they can't afford it. So that was one unintended effect. As a result of that, in like 2012, 2013, the Affordable Care Act instituted the individual mandate. They basically said, all right, look, we can't have younger folks coming out anymore. We need everyone to sort of be in so that we have an even age-based profile. So we are going to penalize you if you don't have health insurance. You're going to pay an extra fine at the end of the year when you file your taxes. And that was the idea. It's, all right, we have to incentivize people to stay into this pool. It worked in some capacity. But a lot of people would still accept the fine, especially immigrants and sort of lower compensated folks would accept the fine rather than pay monthly premiums because the overall cost was still more doing that. So it sort of had its ups and downs. That was what's going on in terms of costs on the people-to-people level. What's going on the carrier level? Carriers, as I sort of mentioned in my first note, they're no longer allowed to look at people based on their actual health history. They can no longer say, okay, you have this condition, you have that condition. So they have to sort of be blind to what people are doing. They have to just say, okay, I'm covering you no matter what. Here's your rate. I'm covering you. They were responsible for providing certain levels of coverage to people who were unhealthy and they didn't know about it. So as a result, it took a few years for them to adjust how they were rating things and work out their profiting. Because obviously, if they're not making a margin and they can't make money in the business, they're not going to participate in it. So prices went up very quickly because they couldn't accurately predict their risk. Second, carriers were responsible for filing roughly a 3% tax on everything every year. And so like this year, there was an additional 3% tax that got added on to carriers for 2020. So everyone in the market, whether their prices were staying the same or going up a little bit, everyone immediately got a 3% uptick like this year. It's been happening basically every other year. That's as a result of carriers being taxed and putting their money into the pool. And the last thing is that carriers are also required to share their profits. If one carrier has a good year and they arrange for a medical plan that does very well, people buy into, and they model it appropriately, they're paying claims and they're still making a margin, they have to subsidize the carriers who did badly that year to sort of make everyone even. So like in 2017, Anthem Blue Cross Blue Shield in Connecticut was by far the most profitable health insurance carrier. They had a plan that everyone in the state wanted to buy in the small group level. They did very, very well. At the end of the year, they wrote a check to the government for $100 million. And as a result, the next year, they had to increase all of their rates by 35%. So no one bought their product in the next year. Again,
So this is to protect the other businesses. Like, is this to make sure there's no bubble and it like pops and everything goes down the well?
It's a pretty complex. It all has very good intentions. The legislation, but it has very complex mechanisms that basically try to control some of the nuances of how the market works. It's trying to control the way that carriers rate people. It's trying to control the way carriers can profit, and then try to spread all that out across a lot of people. They try to get everyone of every age band in. They try to get all carriers, whether they're profitable or not, in. They're basically trying to just create a level playing field to stabilize things. Again, all very good intentions. I think where it had some unintended effects is that the market is used to operating in a free market manner. It's used to carriers saying, okay, like my incentive is to give people a medical plan that works for them at a low cost. So how do I do that? And okay, I'm going to price it this way, that way. If I'm making a margin, great, I can continue to do this. If I'm not, I'm going to change what I'm doing. That's the way, the free market works. With the legislation here, it's sort of saying, okay, carriers, this is what you have to price things by. If you have a good year, you have to give some of your profits to the people who had a bad year, and then you will have the bad year next year, and then it'll keep sort of, teetering this way. So it's in short, it's super complex, and it's a lot to handle. And again, because of some very fine nuances, it hasn't exactly clicked the way it was supposed to. Not that it's good or bad. It's just overall, and this is my second bullet point, in 7 years following the mandate, medical insurance doubled in price. And there are a lot of other things going on into it. Again, these are some unintended effects, but that's where we stand today is, 7 years into it, medical insurance prices double. And so obviously it's now a very highly politicized topic. It's like, okay, what are we going to do with healthcare down the road? And I'm going to get into that in a couple slides. But let me tell you how Connecticut and most of the small markets have responded to that, because this is pretty important. In 2017, again, this is sort of at the end of this period where prices, the insurance market double. A lot of carriers in Connecticut recognize that this is not a good business for them. They can't make money in this, and if they're required to participate, they're sort of bound to be unprofitable. So it started with two carriers. It was Aetna and Anthem Blue Cross in Connecticut. They pulled out of the Affordable Care Act market. They basically said, we're no longer participating. We can't sustain this. And they created a market of their own where they said, look, we're going back to the old school model where we will rate groups based on their actual health history. We can't necessarily just give a blanket rate to everyone and not know, where the bad risks are, where the good ones are. So we're going to look at your group as a whole. We're going to ask you to disclose what you've had in the last 5 years, what your conditions are. We're not going to exclude anything from your coverage, but we're just going to rate you appropriately. So if you're a healthier group, we'll help you save 30%. And that's where the market stands today. It started with those 2 carriers in 2017. It's now 5 carriers as of August 2019. And almost every small company in Connecticut with at least 5 employees is trying to get into this very aggressively. I'd say, at least 80% of small companies are applying for it now. And of those, maybe half are being qualified to get in. So that's what's going on. Everyone is sort of moving away from the Affordable Care Act mandated plans and are trying to get into the old style market where they can have a little bit of cost relief. And where that is important for small businesses is if you have 5 employees, this is a market that you are able to access and that you should attempt to access, because it will save you a lot of money and provide you long-term cost stability. So that's just kind of a snapshot of what's going on in the Connecticut landscape. I'll pause for a second and just see if anyone has any questions here. This is probably the most, lecture-based, nitty-gritty, detailed piece here. Everything else is going to be a little bit lighter. But this is where the market's going and what small businesses are trying to do about it.
So I have a question. Obviously, I keep bringing this up, but so this is worse for people with chronic illnesses, people that have prescriptions, people that need more health care. So the discrimination, that's like more of a risk of that. But as a small business, like you're supposed to take this into account without discriminating. Like, how does that work exactly?
Yeah, so it's not discrimination because let me back it up. If you have a group where you have people who have high cost chronic conditions and they may not qualify for something like this, the Affordable Care Act plans are still in place. Like you can still access that. You have no lesser access to it than you did before.
So the companies that are like, we're going back to the old way, we don't like the Affordable Care Act. Yeah, how does that work?
Right. So for those companies, it's that the plans themselves are structured as private contracts with the health insurance company. And so the employer is working with the consultant, going to these insurance companies who participate in this market and say, we would like a private health insurance plan. And because, we're willing to forego some of the luxuries of the Affordable Care Act, such as unlimited mental health coverage. That's one thing that you're foregoing. Such as other mandates related to in vitro fertilization, to mention one thing. There are certain things you're leaving behind that may be bad, but you're leaving behind. You're saying we would like to structure a private health insurance plan that appropriately rates our group based on whether we're healthy or not. And if we qualify as a group as a whole, great, we'll save a lot of money and we're going to be very happy with that. If we don't qualify as a whole, it's not like one person is excluded and everyone else is in. It's like, no, we're as a group as a whole, we're in or we're out. And if we're out, it's fine. We still have the Affordable Care Act plans that we can access. So it's simply that it abandons certain mandates to allow for a new silo to do basically a private transaction.
Interesting. Okay, yeah. Thank you for answering that question.
Yeah, of course. I'm going to quickly move on and discuss some of the other things that are going on that are contributing to high insurance costs in the United States over the last several years. And again, this is not solely legislation. There are so many other factors that are going on here. And this is what, the legislation is meant to combat. So first and foremost, we have an aging population, and that's no secret. The Medicare eligible population is the fastest growing group of individuals in the country. And as you can imagine, when you're getting older, you inherently are going to have, higher medical needs and more medical costs going on. So with that population increasing, driving costs, it's affecting the whole pool. That's kind of a no-brainer. But these next two are kind of interesting, something from the medical sector and the pharmacy sector. The first is that with doctors, the practice of what's called defensive medicine has been going on since the early 2000s. And basically the idea is that hey, if I have a patient I'm working on, they may not necessarily need an MRI to look at their ankle, but I just want to make sure anyway. So let me just, I'm gonna prescribe them the MRI. I'm gonna have them go get the MRI done. The insurance is gonna pay for it, so who cares? Let's get the MRI just to be sure. There's obviously there's a very fine line to where it's, that's necessary and probably a good preventive practice versus it's unnecessary. You don't need to do that because it's high cost. So there's a fine line there, but there has been widespread defensive medicine happening since the early 2000s because a lot of insurance companies were fronting the whole bill for it. So doctors were like, yeah, go get the MRI, why not? Between 2000 and 2007, utilization of MRIs in the United States increased by 70%. Again, that's not people needing it's not like something new happens where everyone needs the MRI. It's just the utilization increases. There's not an answer for that other than defensive medicine. To take it one step further, in like early 2000, Yale New Haven Hospital had 2 MRI machines. Today, they have an entire floor dedicated to diagnostic imaging. So it gives you an idea. It's widespread usage now. The second thing from the pharmacy sector, in 1997, Food and Drug Administration approves television advertisements for pharma, whereas before you couldn't advertise on TV. At that same time, Lipitor, which is a very popular high blood pressure med, comes out in 1997 alongside this FDA approval. They become the most prevalent and highly advertised brand name drug on television in the United States. By 2003, they're the #1 selling drug in the United States of all time. Even to today, their 2003 numbers still reign today as the #1 selling drug of all time. It was priced at $185 a script, which back then is considered an egregious pricing. That was like unheard of to be in 3-figure pricing. Today, having gone for 23 years of TV ads for pharma, you now have many high-cost drugs like Humira, Eliquis, Xolair being 4-figure pricing. A prescription for Humira is close to $8,000 today. Prescription for Xolair, which is like an asthma drug, over $3,500 today. So that this is showing where pharma has captured this marketing with television advertising and totally capitalized on it. So that's a huge thing. Prescription
Does
drugs.
insulin figure into this? Because I know insulin for me is very, very expensive and they're trying to cap it in different states.
Yeah, absolutely. And, there are attempts to create, generic insulins and generic versions, but, brand name insulins still sell, very highly. So,
yep. Okay.
And then lastly, we already touched on this a little bit. Obviously, the effects of government legislation, not just the Affordable Care Act, but some others. Again, younger demographics are being priced out, so the risk pool is a little bit unhealthier than expected. Carriers are having a tough time because of various economics and cost-sharing duties. The risk pool is becoming unhealthier, and the insurance market is responding and trying to evolve to it with these alternative healthy group options that are, moving away. So it's a lot of things going on, but prices are going up steadily. So what can you do as the employer to mitigate those prices? There must be something you can do to avoid your insurance costs going up by 15% every single year.
Yeah.
Here are a couple of ideas. We touched on structuring your network before. This is a big one. Structure your network with a defined, localized border. Use an HMO network. Most companies based in Connecticut don't have a lot of employees that are venturing outside of maybe the tri-state area or Massachusetts at the farthest. No one's going to Pennsylvania or Ohio for medical services. We have all the best hospitals in the tri-state area that you would need, including Sloan Kettering in New York, Smilow Cancer Center in New Haven. Like, you have what you need here in the tri-state area. So build your network for either Connecticut alone or the tri-state area, Connecticut, New York, New Jersey, or Connecticut, Mass. You don't need access to California unless it's an emergency basis. That'll drive down your costs. Health reimbursement arrangement. This is what we talked about before, where you're funding your employees' deductibles if they incur it. That allows you to get a much richer medical plan than you would have otherwise. You bear those costs if they get incurred, but you're not necessarily paying for them. That drives down costs. We talked about high-cost pharmacy now. It's now widespread usage, if you have a very good consultant who knows how to arrange this, to get what's called a pharmacy benefit manager attached to your medical plan that imports high-cost prescriptions from Canada and the UK. And that's, I'm going to pause there for a second. That sounds crazy, but that is the number one cost-saving solution for a lot of medical plans.
And that's legal.
Oh yeah, of course.
That's interesting. Okay.
So if you have someone who, who's taking the Humira for $8,000 a script, import it for Canada for $1,200. That's the idea, and you can get something tacked on your medical plan to help do that.
Interesting.
Number 2, incentivize positive consumer behavior with your employees. Like, do your employees know that they can use preventive visits for free? Your annual physical, women's OBGYN, all free, covered in full, period. Are you getting all those things done to prevent things down the road? Educate them on that, and reward healthy habits. Have weight loss programs at your companies. For the person who loses the most weight in X time frame, we're going to contribute to your health savings account, or we're going to contribute to your costs a little bit more because you're promoting our health for the group and getting us in a better position.
Is dental like an add-on for that, or is that like a whole separate thing?
Dental is a separate thing, but kind of similar. Yeah.
Okay.
Educate employees on how to use the plan to their optimal level. Understand how to navigate carrier networks. You can go here for $500 X-ray or here for $100 X-ray. Understand what that difference is, where to go. And understand how to best manage your pharmacy. Your doctors have an incentive to put you on the highest cost medications possible. So understand where your generic alternatives are. Rather than the $120 brand name drug, get the $5 generic. It does the exact same thing.
And this would be hiring someone like you to help us with like specifics about like what to offer your people, and like you would learn more about that by hiring someone from your company.
Right, exactly. Yep.
Okay.
And lastly, we already talked about this a little bit, but with new markets becoming available as a sort of alternative to the normal market, go into those. You're going to save 30% if you have a group that's fit for it. These markets are sometimes called the level funding markets. That's what I was discussing before. And they have in turn created consortiums and captive pools that basically say, look, even if you're a small company, you're only 2 people and you don't qualify for this, we'll join you with 10 other companies of your size, and now you're a large pool of 20, and we will rate you as a sort of new group of 20, and you're sort of part of this larger pool to get cost saving. That's what a captive pool does. So the short answer to all of this, and the message with this presentation, is that this is not a commoditized business. It's not, okay, this is a good plan for me, that's a good plan for me. There are so many nuances to this. It's really, really in depth. And to do this properly and to maximize your dollar, you really need somebody as your advocate working, on all these things.
I have a question about COVID. How would you think that this is affecting everything?
Yeah, it's interesting. Obviously, insurance carriers are paying for most COVID visits. They're paying for testing and treatment in full in most markets. So that is obviously a bill for them. That will be something that drives costs up. But conversely, what's funny is everyone who's quarantined at home who may have been planning on getting an elective procedure, such as plastic surgery or something else, they're now not getting that, and so the carrier is not paying for that. Overall, between those two, it's been a net down in overall costs. So carriers are actually, their loss ratios are a little bit better right now with COVID than it was before. I think people are now starting to rethink whether that procedure is totally necessary. Do I need the follow-up MRI, or can I go with basic X-ray, that type of thing?
And people are doing telehealth a lot more. So how does that change? Are those different costs?
No, telemedicine is baked into almost every medical plan that you can buy through the group market. I haven't discussed that here, but that's been around for like 10, 15 years now. Telemedicine is really, really great. Obviously, a lot of people don't have any other option right now because they can't get out into the world. Yeah, great question.
Okay, thank you.
Very last slide. I think this is going to be the fun one. Where's the health insurance industry heading? And I'm hoping I get some questions in this one, but I'm gonna give you a hint. And if you look at the bottom right-hand corner of your screen, I think that you will be shocked to see what happens in the health insurance world in 10 years. But what's going to happen with the Affordable Care Act for starters? Well, we talked about how a lot of small employers are attempting to exit the ACA mandated plans for these alternative markets. And, there's a possibility that some of the dynamics reverse itself and the ACA becomes, a little bit more favorable than it is currently. But right now, it looks like most small businesses are phasing out of that. As we know, the risk pool is becoming increasingly unhealthy because of age, gender profiles sort of being phased out, and also because all the healthy groups are going to those new markets. And the ACA market is being left with the groups that are a little bit unhealthier. So that's going to sort of perpetuate costs going up. Again, an unintended effect, but that's certainly happening. As we know, claims are outpacing carrier revenue, so carriers have to accelerate the cost of their plans. A $300 monthly premium will become a $400 monthly premium next year to $500. It's going up and up. And lastly, the insurance carriers themselves are now leaving the ACA market because they can't make any money there. So, what's the possibility for a single payer healthcare model, universal healthcare? I know this is a very hot political topic. I think that if you were to ask carriers or anyone who's really in the health insurance business, even small employers who currently have employer-sponsored plans and have seen what the trends are doing, I think that you'd get a different answer than what you're often seeing on TV and the news. And some of the considerations to make are that with a single payer healthcare model, you inherently have a reduced incentive for doctors to enter the market and to remain and excel in the medical field. And to put it into perspective, the average reimbursement that a doctor receives for a Medicare patient is about half of what they receive for a private health insurance plan. So if they are conducting, a preventive visit, a women's OBGYN, a basic visit, you're talking about insurance reimbursing them $100 for that visit for their time versus Medicare reimbursing them $45. So as you can imagine, if you have a group of prospective medical school, young undergrads that are considering going to med school, to doing the residency and becoming doctors, if the incentive isn't there to be able to capture on that economically and build a practice and make the money they want, again, for better or for worse, they're less incentivized to go through 4 to 6 years of medical school, 2 years of residency, 8 years of not making any money, to then be in a market where you're getting reimbursed $45 for the visit that you used to get reimbursed $100. So again, there's an economic incentive there. And I think if you were to ask a lot of doctors who are in their late 50s, early 60s, they would tell you that they would just leave the market entirely. I can speak personally. My father-in-law is a cardiologist in the Palm Beach area. I was down with him these past 6 weeks. He gets, if he were, and he sees a very few number of patients now. He's in his 60s, but if they were to go to a single payer model and he were to get Medicare reimbursement rates, he would just leave his practice. It's not worth his time. To get reimbursed $70 to do a 3-hour cardiovascular exam, it's not worth his time. So why would he continue to practice? So,
well, medical school is so expensive. So I have a question of that. Do you think if anything happened where that expense went down, that would change that?
Sorry, what do you mean by expense? Just to clarify.
For school, like college being less expensive.
Yeah, I'm sure that would incentivize people to get into the market. Yeah, correct. So okay. that would be one mitigant. I know NYU, Langone is now, they fund medical school for all their candidates now. So you're right. That could be a combatant to that for sure. But I think that the bigger problem is once you're in the medical field, is what's the incentive to continue to innovate the sector, to innovate the industry? Like right now, without a doubt, healthcare is at its all-time high in terms of quality. Like, people live healthier, longer lives than they did at any point in history. It's a result of there being an economic incentive to develop the new diagnostic imaging, technology that's going to, identify something wrong in a person. There's a money incentive there. It's, hey, if I can identify this, or if I can innovate this particular service, make it better, help people diagnose this problem quicker, I can gain more patients, I can build a better practice, I'll contract more of the market. So there's this sort of level of competition that's raising the quality of care for sure. And the question is, does that remain in place if you can't get compensated for it? If you know that I can't determine my own costs now, I have to just accept whatever Medicare pays me. Think about how many doctors go to med school to become private orthopedists that deal with like professional sports teams. They don't accept insurance. All they do is accept cash because they are the best at what they do. They were the top of their class in medical school because they want to be able to negotiate their own price. I'm the knee doctor for the New York Knicks. I will do your ACL surgery. I'm going to determine the price because it'll be the best that you can get anywhere. There's a market value to that. And that would go away if there's a single payer determining the price there. So that's certainly a consideration. And then just quickly, obviously, the government being involved in your personal medical decisions. For anyone who's currently Medicare eligible, they would understand this, but like you lose control as to what you want to do. If you have something going on in your wrist, you got an x-ray, it's negative, you feel like you want a second opinion, or maybe you want to get another one at a different angle or an MRI, you have to get Medicare approval for that. And at some point the government says, no, you know what, you don't need that MRI, you're not going to get it. So there is an aspect of personal freedom that you lose a little bit when someone is either approving or denying what you can do, because they're the only, controlling party of that. So, what are some alternative models other than a single payer model that might be, a better solution? And what's going on actually in California right now, for anyone who knows Kaiser Permanente, and I'm familiar with that name, this is probably going to be the future model for a lot of the current health insurance carriers, where they purchase a hospital group outright. That would be like Anthem Blue Cross Blue Shield purchasing Waterbury Hospital and saying, look, this is now our site of service entirely. You don't have any option. It's not like state-based network. No, it's here is where you come for your services. You can use our doctors, our facilities. You have what you need. And by doing so, we can control costs entirely. We can control what's being charged. We can control what the doctor is billing for. We contract with our doctors. So that's what Kaiser is doing right now in California. It's become wildly popular. They basically own a number of different clinics and sites of service. They can very easily control the cost that's coming in and out, and they're making it very affordable for people over there to have a private health insurance plan. So that's something that we're probably expecting down the road. And we've actually heard that some carriers in Connecticut are already in talks with local hospital groups about that.
And that's beneficial for doctors, like what they're making?
It's beneficial because for doctors, because they can retain their private contracting with health insurance carriers. They can choose to either participate or leave, right? Whereas with a single payer system, it's either participate or you're not allowed to practice in the country. Okay. So it's either, okay, I can join the Waterbury Anthem Hospital Group and I know what I'm making and I'll get reimbursed this for every service, or I can go out on my own and be my own private practice. Okay. So that would kind of be, a possible answer. And then, sort of within that, health insurance companies reimbursing doctors based on their outcomes rather than what their contract says. So it's, hey, Dr. Smith, you performed this, spinal surgery and you had to do it 2 or 3 times before you got it right for the patient over the course of 6 months. We're not going to pay you for 3 surgeries. You didn't do it right. We'll pay you for 1, based on the outcome. So that would sort of reduce, a little extra fat being on medical plans today. So with no further ado, I will just quickly note that Amazon, Apple, and Google, the big giants of the Silicon Valley, have been aggressively researching the fundamentals of contract and network negotiations among health insurance carriers and providers for the past 5 or 6 years now. And what a lot of people are expecting is that someone like Amazon or Apple will put in a massive amount of money up front to essentially buy out the contracts of existing health insurance companies. That Amazon will then become the health insurance company. Amazon, through their data analytics, will be smart enough to identify where the high value contracts are and how to efficiently price healthcare on the market. They will redefine the way that doctors are reimbursed. They will redefine the way that plans are set up, again, based on data analytics alone, to say, here's what we see as being an area of efficiency, and that they will now become the new Anthem Blue Cross, the new Connecticut, the new Aetna or Cigna. That's a very real possibility. There have been a number of articles in the news about this. So in 10 years, don't be surprised if you see the Silicon Valley taking this industry over.
And Apple too, huh?
Apple, yep.
That's crazy. Wow.
Yeah, it's going to change dramatically. My master's is in healthcare administration, and my last corporate job was with United Healthcare.
Oh,
and I
great.
spent the last 6 to 9 months of while I was there working on kind of doing some competitive analysis on the telehealth area though, and seeing who are the game players in the telehealth area. And you got the Oscar Health, you got Kaiser, like you mentioned. There's a lot of really just game changers that are going to really transform healthcare and health insurance. And I wouldn't even say 10 years. I would give it 3 to 5, and it's going to be completely different.
Oh, I don't doubt that for a second. I'm sure. I mean, something needs to happen,
Yeah. And
Well, I would say
they're working on it a lot.
I would ask both of you, like this could go one way or the other 100% based on who becomes the president. Like right?
Yeah, I mean, without a doubt, there's obviously a political give and take, but I think that at the end of the day, like doctors still have a lot of pull into what happens. Like, let's say, things were trying to go to a single payer system. Like, ultimately, it's either doctors participate or they don't, and they're not allowed to practice anymore. That's major, And I think that even if something were to be in the works to sort of perpetuate that, I think it would be a long time to sort out. I don't know. I just don't think that would be realistic. I think to Samantha's point, I think that promoting telemedicine, lower cost forms of care, hospital site of service models like Kaiser's doing in California is probably more likely. But who knows?
Interesting.
We'll see.
Yeah. So no political really. You think that that's going to be the way it goes?
Yeah, I mean, I think the market is bigger than political sway. I mean, so much would have to happen to really turn it on its head. And I don't know. I think in the near term, 5 years. Listen, it's just me. I think that this is more likely that the market evolves down this road rather than being eliminated altogether.
No, that's fascinating. Thank you.
But what do you think, Samantha? I mean, I wasn't aware that you have the healthcare administration piece. So I have an expert on the other end of the line here.
Yeah, I basically grew up in healthcare. I went to a health science high school, so it's like 20 years deep now. I don't know. I think that with there's such a high percentage of younger people who don't have health insurance, who are uninsured, and they're not looking for health insurance. And I think that is such a huge part of the dynamic that is constantly ignored. And so working with United Healthcare, we had to always take that into consideration, that not everyone has a PCP, a primary care physician. Not everyone is going for their annual visits and doing all the assessments they're supposed to be doing. And so there's a part of the healthcare and health insurance model that is already being vacated by a lot of people in the general population. Then you have the older people, and like myself, I'm like at the high end of the millennial, right? So you have like myself, my husband, we still have primary care physicians. Our parents, they have it, they grew up in that model. But like my younger cousins and younger siblings and things, they may not have it. They don't see the purpose. They don't see the point of paying into the system. You know, a lot of them too feel like they're invincible. So why am I paying into this system when nothing's ever going to happen to me? You know, look all the young ones that was on the beaches in Miami saying they couldn't get coronavirus. So
Right.
My brother was one of those people. I am very upset with him.
see, and then he puts you at risk,
Oh,
right?
yeah.
So, you know, you have all that to think about, and then you think about what needs to change. You know, United Healthcare was one of those organizations pulling out of the ACA because it wasn't profitable for them. They was losing a lot. Well, I was laid off in October because of what's happening in healthcare, because the health insurance companies are afraid of the universal healthcare model. They do see that as something that is going to significantly impact their revenue and profits, and they're already making cost reductions to prepare for that. So that is a real issue for a health insurance company. And I mean, they're rich, they're loaded. You know, the CEO of United is making millions a year. So for the little people like us, you know, we don't really see the differences. We don't really see the differences, but it's my coworker's lunchtime. But the people at the higher levels, they want to cut their losses now and get rid of those extra salaries to protect themselves, cushion themselves a little bit more, because it's like impending for them. And then, you know, I was doing a market analysis just in the telehealth area alone, which is huge and expanding, and I'm sure more came out of it since the whole pandemic.
COVID, yeah.
Because we couldn't even, as I was researching it, there were more telehealth industries being created as I was researching it. So I know there's more coming out, and they were only researching that particular area of health insurance and healthcare. And so, and that right there was transformative to them. They knew that there was all these innovative type organizations coming about that was going to severely dismantle everything healthcare stood on. So
both of you, I guess, at this point, what would your ultimate is bringing it back to small business advice be?
I don't know. That's why I'm here.
Well, my advice is that if you don't already have a medical plan running through your business, again, whether for yourself or for your employees, you should. In 95% of situations, it's going to save you a lot of money versus the individual alternatives. And then if you do that, it's just about being very smart about what you're doing, and working with someone who really understands the market and how to stretch your dollar on that plan to maximize the value. And that's all I said. That's really the message today. And
your slide with the secrets, pay attention to that.
That's it.
Well, thank you. Does anyone else have questions?
Yeah, Celeste or Nicole, if you have questions, we've been asking the whole time, but.
Yeah, thank you for the continued questions throughout the presentation. It's been very, very good.
Yes,
it's been so
you.
helpful.
This was very informative.
I'm excited that we recorded this so that more people who couldn't attend on a Monday morning can see it. And my dad owns 2 small businesses, and I'm not sure what his health insurance situation is. So I'm going to definitely make him watch this.
No, as a small business owner, this was awesome. I think that, yes, putting it on the library's website and so that people can review it later, I think is really good to have, especially now during this pandemic where, so many people's livelihoods has shifted around so much that maybe those who never thought about it need to consider it. So I think it's good to have this material here. Thank you.
And in the chat, Nicole said, thank you very much for the good information.
Oh, thank you, Nicole, for listening, and I appreciate it.
Awesome. So this is Matt's contact information. If anyone needs to reach out to him, he is always available. Matt, thank you for presenting today. Reach out to us if we can help.
Okay, will do.
And then everyone, enjoy the rest of your day.
You too.
Bye, guys.
Safe.
Bye.
Thank you.